Welcome to Concept Craft. We are presenting step-by-step videos training to crack your certification exam, so you can gain the confidence to take on any accounting challenge. Now let's begin our today's lesson.
Using journal entries. Learning outcomes. In this lesson, we'll cover using journal entries and adjusting journal entries in QuickBooks Online. Topics: how to use journal entries, creating a journal entry, about adjusting journal entries, Pro Advisor Challenge, when one size doesn't fit all. Clients usually use sales and purchase forms to record income and expenses in QuickBooks Online. However, sometimes these forms just aren't appropriate for the client's purpose. How can you in QuickBooks Online help? Journal entries in QuickBooks Online is a way to post debits and credits directly to accounts in the general ledger. They allow you or your client to move money between accounts and adjust your client's books in specific ways. Let's see how it works. How to use journal entries. A journal entry is an accounting transaction that posts directly to the general ledger. You or your client can use journal entries as another way to adjust account balances. They're useful, for example, to correct errors or summarize the depreciation of assets, but you or your client may also use journal entries to enter debits and credits manually, transfer money between income and expense accounts, or from an asset, liability, or equity account to an income or expense account. Before we dive into how to create them, let's look at some rules regarding journal entries. Total debits must equal total credits. You can't use product or service items in a journal entry. When posting to accounts receivable, you must specify a customer. When posting to accounts payable, you must specify a vendor. You can't mark an amount as billable to a customer. You may use multiple accounts receivable and/or accounts payable accounts in the same journal entry. Creating a journal entry. Let's see how to create a journal entry for the depreciation of equipment that was donated to the business by the owner. Select Plus New, then select Journal Entry. Set the journal date. Enter or accept the journal number. In the Account column, select Add New. In the pop-up Account window, add the account type. In our case, it's Fixed Assets. Next, select the right detail type. Because we're creating a journal entry for equipment depreciation, we select Machinery and Equipment. If the client wants to track depreciation, check the Track Depreciation of this asset box and leave the original cost and depreciation fields blank. Then select Save and Close. Back in the Journal Entry window, in the Debits box, enter a debit amount. Add a description in the Description column. In our case, it's the contribution of the equipment. In the next row, under the Account column, we select Owner's Equity from the drop-down. Notice that QuickBooks Online automatically populates the credit matching the debit and the description in the line above. Next, select Save and Close. About adjusting journal entries. An adjusting journal entry is a type of journal entry that adjusts an account's total balance and occurs at the end of an accounting period before the company produces its financial statements. Note that while clients can also create journal entries, only users with access to QuickBooks Online Accountant can create adjusting journal entries. Accountants usually use adjusting journal entries to fix minor errors or record uncategorized transactions. To mark a journal entry as adjusting, just enter the journal entry as normal and check the Is Adjusting Journal Entry? Checkbox. Select the headings to find out more about when you would use adjusting journal entries. Accrued expenses. These are expenses your client has accrued but hasn't paid yet, like loan interest or accrued payroll. Accrued expenses appear on the balance sheet as liabilities. Deferred expenses. This is where your client has paid for something but has not yet realized the benefit. An example of a deferred expense would be if they pay for their insurance a year in advance. Deferred expenses appear on the balance sheet as assets. Accrued revenues. This is when a client has earned the revenue but they haven't invoiced the customer yet. This is a common practice in many industries that work on long-term contracts. These appear on the balance sheet as accounts receivable, which is an asset account. Deferred revenues. These occur when your client has been paid in advance by a customer but they haven't finished the work yet. This appears on the balance sheet as unearned income, a liability. Non-cash transactions. Not all expenses are cash expenses. Some things represent expenses that don't have a cash effect on your client's business. Depreciation and allowance for doubtful accounts are two examples of common non-cash transactions. If regular adjustments aren't recorded to reflect these activities, it's easy to get a skewed picture of a company's financial position. For example, a client that has no liability accruing for their annual loan interest might overestimate how much cash they have. Without ensuring that they keep track of their growing current debt, they will have incorrect information about the profit they make each month. Also, when they make the annual business insurance payment, and it's not accrued, they will have the monthly insurance expense reflected in the wrong accounting period. Pro Advisor Tip: as an accountant, you can set adjusting journal entries to post automatically using the Recurring Transactions feature in QuickBooks Online. That way, you know that most, if not all, of the necessary adjusting entries are reflected when viewing monthly financial reports. For more information, check out the lesson on creating and using recurring transactions. Summing up. Learning outcomes. Well done. In this lesson, we covered using journal entries and adjusting journal entries in QuickBooks Online. Knowledge recap. A journal entry in QuickBooks Online is a way to post debits and credits directly to accounts in the general ledger. An adjusting journal entry, by contrast, is only accessible to users with QuickBooks Online Accountant, and it's an entry in a company's general ledger that occurs at the end of an accounting period before the company produces its financial statements. Next steps. In the next lesson, we'll look at using the transfer function.